Your bank has a secret file on you. Not the kind with your social security number and your mother's maiden name, a different kind, a profitability file. And somewhere inside that file is a label that determines whether you get a dedicated banker who picks up on the first ring or whether you get stuck listening to hold music for 45 minutes while a robot asks you to describe your issue using one word. That label is based almost entirely on one thing: how much money you keep in your accounts. And today, we're going to walk through every single tier, from the bottom to the very top, so you can see exactly where your bank has placed you and what it takes to move up. Let's start with a number that sets the stage. It costs your bank somewhere between $250 and $400 per year just to keep your account open. That covers the branch, the teller, the fraud team, the app on your phone, all of it. Now, if you have $1,000 in savings, your bank earns roughly $30 a year off that deposit. They take your money, pay you almost nothing, and lend it out at 7% on a mortgage or 24% on a credit card. 30 bucks in, 250 to 400 out. You are not a customer. You are a cost center, and your bank knows it. A profitability study on a $40 billion regional bank found that roughly 48% of all customers generate close to zero or negative profit, nearly half. Meanwhile, the top 0.04% of clients generate 10% of total profits. The bank could wave goodbye to 90% of its least profitable customers and still keep 85% of its earnings. So when nobody seems to care that you've been a loyal customer for 15 years, this is why. The math says you're not worth the phone call. Now let's walk the ladder, because banks don't just have two categories. They have very specific dollar thresholds where everything changes. Below $1,500, you're in what I call the penalty box. Banks charge you money for the privilege of holding your money. Chase charges $12 a month on basic checking unless you hit $1,500 or set up direct deposit. Bank of America does the same, 12 bucks a month. That's $144 a year being siphoned from someone who clearly can't afford to lose $144. It's like charging a gym membership fee for standing outside the building and looking at the equipment through the window. And the cruel irony is that those monthly fees make it even harder to build up enough of a balance to escape the fees. It's a trap designed to keep you exactly where you are. $5,000 to $20,000, the fees get waived, but you're invisible. No perks, no dedicated service line, no relationship manager who knows your name. You're basically a ghost in the system. The bank acknowledges you exist. That's the full extent of the relationship. You could walk into a branch and nobody would treat you any differently than someone who opened their account yesterday. $20,000 is where things start. Bank of America's Preferred Rewards Gold kicks in here with a 25% credit card rewards boost, mortgage fee reductions, and auto loan discounts. Citi Priority starts at $30,000 with a dedicated service line. The bank's internal system has probably tagged you as emerging affluent, which sounds like a cologne brand, but actually means you're worth keeping around. At $50,000, Bank of America Platinum delivers a 50% rewards boost and a TM fee refunds. A relationship manager might actually call you, not out of kindness, definitely to sell you something, but at least they're calling. Now, here's the tier that matters most for the people watching this: $100,000. This is where everything shifts. Bank of America Platinum Honors at $100,000 has been called the single best consumer banking perk in America. Your credit card rewards get a 75% boost. A 2% cashback card effectively becomes 3.5%. unlimited ATM refunds, mortgage discounts. At Chase, $150,000 gets you private client with a dedicated JP Morgan advisor, worldwide ATM refunds, and sign-up bonuses reaching $3,000. Citigold at $200,000 adds exclusive lounge access and complimentary financial planning. This is the tier where you stop being a number and start being a name. $250,000 and above is where it gets genuinely ridiculous. Wells Fargo Premier assigns you a dedicated banker with 24/7 support. Citigold Private Client at $1 million gives you a $595 annual fee rebate, luxury hotel upgrades, and a World Elite debit card. Bank of America Diamond Honors at $1 million gets you invitations to events curated by Louis Vuitton and NetJets. At $10 million, you enter true private banking, a team of 3 to 5 people dedicated to you. Relationship manager, investment specialist, tax strategist, estate planner. The client-to-advisor ratio at JP Morgan Private Bank is roughly 12 to 1. Your basic checking account shares one service rep with about 10,000 people. That's the difference. Here's the part nobody talks about. How banks make money off you changes completely depending on your tier. Lower tiers, it's fees. Overdraft fees generated an estimated $12.1 billion in 2024. 9% of account holders incur 10 or more overdrafts per year and generate nearly 80% of all overdraft revenue. Think about that for a second. A tiny slice of customers, the ones living paycheck to paycheck, are funding the bulk of the bank's fee income. The most financially vulnerable Americans paid over $6 billion in overdraft fees in a single year. Banks are essentially running a business model where the poorest customers subsidize the perks that the wealthiest customers enjoy for free. Meanwhile, a high-balance customer with $250,000 in checking earning 0.01%, while the bank lends at 7%, generates $7,500 a year. They don't need your $35 overdraft fee. You're already making them rich just by parking your money there. The cross-selling also changes by tier. If you're in the lower brackets, the bank offers you overdraft protection and a basic credit card. Cross the $100,000 line, and suddenly you're getting pitched wealth management, premium lending products, insurance bundles, and estate planning, all of which carry much fatter margins for the bank. Now let's talk about where Americans actually stand on this ladder. The median transaction account balance is $8,000. Not average, median. The average is over $60,000, but that's warped by wealthy outliers. Under 35, the median drops to $5,400. 35 to 44, it actually goes down to $4,700 because mortgages and kids drain everything. The bottom income bracket has a median of just $900. The top 10% has $111,600. That's a 124 times difference. 59% of Americans cannot cover a $1,000 emergency from savings. 27% have zero emergency savings, the highest rate since 2020. Meanwhile, Americans believe they need $1.26 million to retire, but median middle-class retirement savings is $66,000. That's 5% of the target. There's also a hidden line in the sand that shapes how banks behave around you, and most people have no idea it exists. The FDIC insures $250,000 per depositor per bank. Below that number, your money is fully protected by the federal government. No depositor has lost a single penny of insured funds since 1933. Above that number, you're on your own. 3 of the 4 largest bank failures in American history happened in 2023, All because depositors with uninsured balances panicked and pulled their money at the same time. For customers approaching that 250 mark, banks get very motivated. They'll proactively reach out to discuss coverage strategies, not because they care about you, but because losing a $250,000 deposit hurts a lot more than losing a $2,000 one. Here's a trick most people don't know. You can actually insure well over $1 million at a single bank by using multiple ownership categories: single account, joint account, trust beneficiaries, retirement accounts. Each one gets its own $250,000 in coverage. So why does all this matter? An MIT study found 80% of people believe they're better savers than their peers. But when shown where they actually ranked, those below average were significantly more likely to increase their savings. Social comparison beat expert advice at changing behavior. The problem is visibility bias. You see your neighbor's car, their vacation photos, their renovated kitchen. You never see their bank balance. Everyone assumes everyone else is doing better, which drives overspending. The $100,000 milestone is the sweet spot. Only about 14% of Americans have 6 figures saved. It's where compound interest accelerates and where banks start offering legitimately premium treatment. Getting from 8,000 to 100,000 is a 12.5 times multiplier. Not easy. But knowing that's where the game changes lets you aim strategically instead of saving blindly. And here's something worth noting. Capital One operates without any balance-based tiering. No VIP tiers, no minimum balances, no monthly fees, no overdraft fees. Same terms for every customer, which proves the elaborate tier systems at Chase, Bank of America, and Citi are strategic choices, not necessities. So the question isn't just, how do I climb the ladder? It's whether you should be on a ladder at all. Either way, now you know the game. Your bank has been grading you since the day you opened your account. They never told you about it. They never planned to. The only difference is now you can see the scorecard. And once you can see it, you can start making moves that actually matter. If this changed how you think about your bank account, subscribe. We break down the money games nobody explains to the middle class every single week. Hit subscribe so you don't miss the next one.